Welcome back. You're with us. Of course, the corporate conversations, the earnings conversations continue. But we also have IPO conversations because there's so much action in the primary market. So we are now putting the spotlight on Brigade Hotel Ventures. The IPO has opened out for subscription today. The company is looking to raise about 760 crore rupees, and it's a fresh issue. So let's discuss all the details, the structure, the business, and the prospects with Nirupa Shankar, Managing Director at Brigade Hotel Ventures. Nirupa, great to have you on. Thank you so much for joining in. And, we wish you all the best as you start your public journey. Now, I want to get the model understood correctly first, because you have several properties and then you have, tie-ups with a lot of brands like Accor, Intercontinental, Marriott, and you pay these global brands, obviously, a revenue for the use of the brand name. But you are not an asset-light model. You own the properties, right? In fact, you've actually, part of the issue proceeds will be to pay back promoters for some land that you've bought from promoters. So just can you tell us whether you'll be buying more land from the promoter group? What is the model? And, what about this royalty that you're paying to these global hospitality brands?
Good morning. Thank you so much for having me here. Yes, it is definitely exciting times with the issue opening this morning. With regards to our portfolio, ours is a build and own model. So as builders, we build the hotels and we own the hotels. We give the operations of the hotels to global international top tier one operators such as Marriott, Accor, and IHG. There are management fees that we pay to them. So it's not really it's kind of a royalty, but we call them management fees. So there's a base management fee and there are incentive fees. So that's a percentage of the top line and a percentage of the gross operating profit. With regards to the land, so currently Brigade Hotel Ventures has about 9 hotels, and all our hotels are either owned or leased. In some cases, we buy the land. So we buy the land, and in some cases, we do long leases for the land. Could be a 30-year lease, a 45-year lease, a 99-year lease. As you know, Brigade Enterprises is the parent entity and the major promoter of Brigade Hotel Ventures. And as Brigade Enterprises is one of the few builders in the country that does all asset classes. So be it office, residential, hotels, and malls. So in some cases where we do large mixed-use townships, because we were one of the pioneers of mixed-use township concept in the country, in some cases we have hotels as part of these large mixed-use townships. So what we do need to sort of move aside or share or buy out the undivided share of the land. So I'm just giving you an example. So suppose we have a 4 million square feet development of all assets. Yeah. And the hospitality composes about 10% of the overall built-up space. We will, Brigade Hotel Ventures will buy the undivided share of the land. Maybe.
Yeah. So just I got the model. Understood that. That was quite helpful. So just on this, Nirupa, two-part question. The management fee that you're giving to the international brands as of FY25, it was about 4.4% of your total revenue. Now, do you have visibility? Will it remain that for the next, 2 years, 3 years? What is the frequency of, or is this an annual fee? How does that cost go? And also in terms of buying more land versus leasing, going forward, will you be looking at more land acquisition, in which case the debt question will become important?
That's right. So the management fees are going to be kind of the same for the years ahead, because the percentage is sort of fixed based on the revenue. So it is going to be 4 to 5% is what our management fees are, as they have been for the last many years of us operating hotels. So there's going to be no change in the management fees. By and large, all the top tier 1 hotel operators have similar models. So our management fees will stay the same. With regards to our strategy when it comes to buying versus leasing, it really depends on the property, right? In some cases, if it's a CBD property where land value is extremely high, we might decide that it's better to lease that property, because hotels as it is are capital intensive assets. You don't want to be spending too much on construction of the property and also on the land. We believe that the success of a hotel is very greatly dependent on the cost of land as well. Land is extremely important component. So in some cases, especially CBD properties or where land is extremely expensive, we prefer to lease and rather than buy, because if we buy, then maybe residential is the better option for better IRRs. But we do have I would say currently the portfolio is 50-50. 50% is leased and 50% is bought.
Nirupa, hi, morning. Just a quick word. I mean, have you sort of considered a REIT, creating a REIT kind of structure, putting some of these assets in there, helps you recycle your assets, right? And help sort of raises capital for you and allows you to sort of move on to newer projects, newer properties?
Yeah, I mean, that was definitely, something we pondered on, whether to do a combined REIT with some office assets and hospitality assets, or just do a standalone hotel IPO. I think we decided that, the hospitality sector, has very specific kind of investors, and it's a very different business model. So we decided that it's better to have a hotel company separate, doing its own hotels and growing that business individually, having a focused team and effort, because building a hotel is very different from building an office. But we have, of course, our office portfolio is also growing, so that's something we could have considered. But I think we have taken the call to take the hotel portfolio by itself and grow that company separately.
As a listed entity now, you won't sort of look at within the listed Brigade hotels trying to create a REIT structure down the line or anything, right? For example, we speak with a listed infrastructure company which has done this. Actually, a few have done this now. They're already listed, but down the line, would you consider it?
I don't think that hasn't been our thought process thus far. We do. I'm not sure if you're aware, but with Brigade Enterprises, we've been building a lot of commercial assets, including many of the World Trade Centers. So World Trade Center, Bangalore, Chennai, Kochi, Hyderabad, Trivandrum is coming up next. So we like to place our hotels next to large office parks as well, considering that office parks are the largest demand drivers for hospitality. But thus far, our thought process has been to keep the commercial assets separate and to keep the hospitality assets separate. Once we've, go ahead with this IPO and we become a listed entity, the idea is to just grow the hotel portfolio, within this entity. There's no plans to do a REIT further down the line with regards to hospitality.
All right. Hi, Nirupa. And, since you're going to be listed, we'll be speaking way more often as well. So we look forward to that. Since you're raising this money, I think you'll be virtually debt-free, post repayment of these borrowings. But for the next phase of growth, how do you fund it? If you could give us the broad outlook out there.
Yeah, so you're absolutely right. Once primarily use of the IPO proceeds will go to debt repayment, and then we will practically be institutional debt free. With hotels, they do have a longer construction cycle, around 3 years, and all our hotels are in the next phase of construction. So they're just going to be starting construction. The funds required initially are not as much. In hospitality, most of the funds required are back-ended towards the third year. Initial year is just design development, approvals, initial start of construction, all the civil work. And then second year also typically is most of the civil structure. And then the third year is the fit outs, and that's when you need most of the cash flows. So while we will be institutional debt free, probably for the next 18 months or so, as and when we do require more funds, we will go back to get more institutional debt. The good thing is, because of the parent entity and the great banking relations we have, and our cost of borrowing is one of the lowest in the country for the parent entity in the real estate space, and that is transferred also to Brigade Hotel Ventures. So our cost of borrowing is around 8.5%, and maybe with the lowering interest rates, that could decrease as well. So cost of borrowing seems to be in check right now. Like I said, we won't require debt immediately, but as and when we do need it, we will sort of enhance our leverage.
And what's the maximum cap in terms of gearing that you'll go to, like a rough debt equity cap that you would definitely have in mind for future expansion?
See, ideally, right now, of course, our debt is a little bit on the high level when you compare it to equity. But going forward, immediately post this, it will be 0s to 1.5, so hardly any debt. Probably the maximum we would be okay with is a 2:1. I know in the real estate space, we've spoken about a 1:1, but in hospitality, a slightly higher leverage is okay. So I think we'd be okay with even a 2:1 in the peak construction cycle. But
Got it.
on a regular basis, you'd probably want to limit it to 1.5:1.
Okay, so 1.5:1 at an average as you fund your future expansion. And that expansion includes so much, right? 5 new hotels, 1,000 keys coming up all the way to FY30. I'll end with one small question because we'll talk more, of course, when you list. But your average room rate, I think, is around 6,500. Just yesterday we were talking to Schloss Bangalore. Of course, different offering, different segment. They were talking about ARRs of 20,000 by the end of the year. So for the segments that you operate in, do you see more elbow room for higher ARRs and maybe even better margins?
Yes, I actually watched that interview, so I did see their ARR of 20,000 plus. We have 9 hotels, and our portfolio is spread amongst many tier 2 markets like Mysore, Kochi, GIFT City. There, the rates are sub 5,000, right? But of course, if we are talking about some of our hotels in Bangalore, it could be between 10,000 to even 15,000. So it really depends. I think Pune, Maldives has extremely high ARR. So it really depends where your portfolio is. But I think one thing we can look forward to with the Brigade Hotel Ventures portfolio is that we are coming up with a lot of 5-star deluxe properties. Currently, the portfolio has a 3-star, 2 4-stars, smart business hotels of 5 stars, but nothing in the 5-star deluxe category, which is where my colleague spoke about yesterday. But I think going forward, we are looking to enhance our portfolio in the luxury deluxe segment. So we have a Ritz-Carlton coming up in Kerala. We have a Intercon coming up in Hyderabad. We have a Grand Hyatt coming up in Chennai. So these are all in the 5-star luxury deluxe categories, and that will and then you will see the ARR go up once those hotels come into operations.
I must say, Nirupa, you poured a little bit of cold water on my hopes because looking at that ARR, I was very sure where I'm going to check in next time in Bengaluru because Nigel is going for the Schloss properties. I was very happy. You're looking at 6,500, 7,000 ARR. But as she describes, those are not Bangalore city properties. They're probably outside. But thank you so much for joining in. Good luck to you with the issue, and we look forward to chatting more frequently now.
Likewise.
Thanks for joining in today.
Thank you so much for having me.
All right. That's the hospitality space booming and thriving and more players coming to the market. With that, I think we need to take a very, very quick break. We'll do that and come back and I think take some trades with Mitesh in just a bit.